welcome back to Mike and his whiteboard. My name is Mike, this is my whiteboard, and today we're going to delve into liquidity. So there's a few aspects of liquidity that we focus on here, and that's going to be open interest, volume, and then a bid-ask spread for an option spread. So today we're going to talk about open interest and volume and how these numbers impact our trading decisions. So with open interest and volume, basically they're defined as two different things, but they're pretty similar. So open interest is essentially the open contracts. So any contracts that are just out there open, they haven't been assigned, they haven't been exercised, they haven't been closed. So how I like to think of it is basically open contracts that are out there that I can become a part of in some way. So volume is essentially tracking the number of contracts that were closed or traded that day. So if an option was open and then closed, that would count towards volume. So there's two different aspects with open interest and volume, but they pretty much work together. And knowing these numbers and having a high number of open interest and volume is going to help us get liquid markets when we're trading options. So let's take a look at our first example here where we're talking about open interest. So again, open interest is the number of contracts open or outstanding. So if Matt sells a put to Joe, then an open interest coin would fall into this bucket of open interest coins. So what's interesting is that it doesn't really matter how this transaction happens. So Matt can sell the put to Joe, or Joe can buy the put from Matt. In any case, as long as this transaction happens and this contract opens between these two people, open interest will increase by 1. So this is important because when people are opening contracts and closing contracts, open interest can actually go up and go down, and in some cases it can even stay flat, which we'll get into a little bit later. But it's important to remember that open interest is essentially the open contracts that are out there, and it can go up, stay the same, or go down depending on the number of transactions that are happening or the type of transaction that's happening, which we'll get into in a little bit here. So here's open interest, but let's look at volume and see the difference between the two. So on the next slide here, we'll talk about volume, and volume is essentially the number of contracts traded per day. So essentially, if Brad sells 2 puts to Sarah, or if Sarah buys 2 puts from Brad, then there's going to be 2 ticks for volume going into that volume container. So what's interesting with volume is that volume can really only go up. Unlike open interest, where it can go up, go down, or stay the same, since volume is really only tracking the number of sheer transactions that are completed, it can only go up. So even if a contract is open and closed, it's still going to count as volume for each of those transactions. So with stock volume, there's a difference here between options and stock. So open interest is primarily looked at from an options perspective, so it shows you the open contracts that are out there. But with volume, for option volume, it's the number of contracts traded in a day. And for stock volume, it's the number of shares per day. So when we're looking at liquid underlyings, we usually look for shares that have traded over 1 million shares a day. So you have your stocks like Facebook, Apple, SPY, which is one of the most liquid underlyings out there. You're going to see this pretty much happen every single day. So now you know the difference between open interest and volume, but what I'd like to do to clarify this even further is walk you through 5 different steps, and we're going to take examples and we're going to show you what happens with these examples when a contract's open, closed, and see what happens with open interest and volume on the next slide here. So in one trading day, so this is very important, so with volume and open interest, we're usually looking at one specific trading day. So we're going to look at Sarah, and she's buying 5 calls from Joe. So a call contract, if we just review, is the right to buy 100 shares at a certain strike price. So Sarah wants to have the right to buy 500 shares from a certain strike price from Joe here. So what will happen is option volume is going to increase by 5. So there were 5 contracts here, so option volume is going to increase by 5. And this little black number in the upper right is going to keep a tally of everything that happens from here on out. So I just wanted to explain that when we see it in the future. So we've got option volume increasing by 5, and we have open interest increasing by 5. So Sarah bought 5 calls from Joe, so they agreed upon that contract, and now this contract is open. So we had 5 contracts that were traded, which gives us the 5 volume, and 5 open contracts, which gives us the open interest. So now let's look at another example, and it's going to be two different people, but it's still going to increase the option volume here, and will also increase the open interest. So Matt and Laura are two different people, and this is a different underlying, let's say. So Matt sells 2 puts to Laura. So Matt is selling 2 puts to Laura, so the option volume will increase by 2, which gives us the total of 7 for the entire day. And open interest is going to increase by 2, so our total has increased to 7 again. So actually, we're going to pretend that this is the same underlying, since we're going to be tallying this up, and we want to keep everything universal, so we'll be looking at the same underlying from here on out. So the next example here, we've got Joe buying back 1 call from Sarah. So originally, Sarah bought 5 calls from Joe, so there's 5 open contracts there. So Joe's buying 1 back. So maybe he's saying, you know what, maybe I don't want to have the exposure of 5 naked calls, so I'm going to buy 1 back, and Sarah agrees to let me do that. So essentially, option volume is going to increase by 1 because that's just another transaction that's taken place. So now our option volume has increased to 8. And open interest has actually gone down by 1. So you can see here that open interest goes from 7 down to 6, and that's because originally, from the first example, Sarah had opened 5 call contracts from Joe, so there was 5 open, but now since there's 1 closed, although we have volume increasing, now we only have 4 open contracts, which is why this number is decreasing here down to 6. So that's very important. And what's very interesting is that we're never going to really know who we're opening these contracts with and who is closing or opening contracts, but this is just a good example to give you a general idea as to how this might happen in the future. In case you see maybe open interest up on a certain period of the day, and then a little bit later if it goes down, then now you know why. So let's look at the 4th example here. So Matt buys 1 call from Sarah. So Matt wants to get in on the call business here. So he is making another transaction. So our option volume goes from 8 to 9. And our open interest actually stays flat. So in this case, since Matt is buying 1 call from Sarah, so Sarah is already short 4 calls. So if Matt buys 1, he's buying 1 contract to open, but Sarah is essentially selling 1 contract to close. So since Matt's buying to open and Sarah's selling to close, there's no additional open interest that's created because she's closing 1 contract, but he's increasing 1 contract in the open interest market. So that's going to be a wash in this case. So again, since Matt's opening 1 and Sarah's closing 1, there's a wash in open interest, which is why it remains at 6. So if we're looking at all of these from the same underlying perspective in 1 trading day, if we go through this again, we've got option volume of 9, and we would have open interest of 6. So this is basically to point out that regardless of what happens, it's very important to know what's open and what's being opened or sold to close and how these numbers are affected. And it's pretty rare to see volume and open interest be the same exact number. But for each of these, what's really important is going to be on our takeaway slide here on the next slide. So when we're looking at open interest and volume, we essentially want to see something above 1,000. That's going to be ideal for us. So when we're talking about just strikes, specifically, if I'm looking at a strike and I'm looking for maybe a spread or a naked option, I want to make sure that either open interest or volume has over 1,000 contracts open or 1,000 contracts traded that day. And that's just going to give me a good indication that there's a fair market for that specific strike, because the more options that are traded or the more options that are open and closed, that gives me a good idea of people agreeing upon the bid and ask spread, which is going to make that spread narrow and give me a more fair market price. And we're going to talk more about bid-ask spread tomorrow, but that's basically why we want these numbers to be higher. And with stock volume, if I'm looking at an underlying to trade in general, I want to be looking at a stock volume of over 1 million shares per day. And that's just because if I'm looking at a stock volume first, I want to make sure that there's a lot of shares in the stock traded per day. Maybe I've got shares along with a short call, so maybe I'm doing a covered call. So I want to make sure that regardless of what strategy I'm using, the underlying shares are traded, are liquid, and that's going to give me a better market price theoretically with the option market. So that's not always the case for underlyings like cash settled indexes like SPX, where you can't actually trade the underlying, but it's a good place to start for stock volume. So some other takeaways here. Open interest refers to the number of contracts outstanding. So again, open interest, I like to think about it as contracts that are just out there that I can be a part of. And these are contracts that are not closed, not exercised, and not assigned. So basically, contracts that are just open that I can either become a part of by selling to open or buying to open, or buying to close, selling to close to reduce that number. And option volume is simply the total number of contracts traded per day. So when we're talking about options, we're looking at contracts traded per day. When we're talking about stock, we're talking about shares traded per day. So it's important to know the difference between the two of those. But essentially, when we're looking at volume, we're just seeing where the action is, if you will. So normally, we will see the most action will generally be around the at the money strikes, but sometimes you'll see a lot of action outside in the out of the money or in the money strikes. But in general, you'll see a lot of liquidity right around the at the money strikes. And normally, when we're looking at that, it's going to be pretty relevant to what we're trading. So if we're trading something like a debit spread where we're close to at the money strikes, then usually that's going to give us a good indication of a high liquidity. So this has been part one of liquidity. So we've discussed open interest, volume. Tomorrow we're going to talk about bid-ask spread, and we're going to talk about basically how this affects our option pricing and why it's good to have a narrow bid-ask spread rather than a wide one. So thanks so much for tuning in. My name is Mike. If you have any feedback or questions at all, shoot me an email at .com, or you can tweet us at DoTrade. Until tomorrow, have a great night. Hey everyone, thanks for watching our video.
If you liked this video, give it a thumbs up or share it with a friend.
Click below to watch more videos, subscribe to our channel, or go to our website.